Hello, and I'm going to show you how to create your financials using PlanPros. So I'm in the financial section, and the first subsection is select your currency. For most of you, it'll just be keep it on US dollars and click Save and Next. Now, this next section is funding requirements and use of funds. This is trying to tell you how much funding you need to start or grow your business. Now, the easy thing here is simply you can click this button here, which is the get list of investments to consider making, which for your type of business, and in this example, I'm using a coffee shop, it's going to list both capital investments and non-capital investments. Capital investments are, and it says it right here, what capital investments are, they're physical assets such as land, building, furniture, etc. And the reason why we specify the difference between capital and non-capital is that capital investments incur what's known as depreciation. Depreciation is simply the reduction in the value of an asset over time. So, for example, you buy a car today for $30,000. A year from now, your car is not worth $30,000. Maybe it's worth $25,000 or something less than $30,000. And this is important for your financial projections because when you depreciate an asset over time, that gets deducted off your taxes, off your tax bill. So that's why we separate the two. So in this case here, we're saying for a coffee shop, they're listing potential capital investments. Most cases for a coffee shop, you're not going to purchase land, so you simply delete that. You're not going to construct a building. You probably have the buildings already there, and you're just going to build out the location, purchase furniture and fixtures, machines, computer equipment. This is about right for a coffee machine, for a coffee house. And then non-capital investments, usually the biggest one is working capital because you can't, in the first few months of a business, particularly if you're starting, you're going to lose money in general because, day one, you're going to pay for staff salaries. And particularly a lot of times you're going to pay for staff salaries before you even open shop. And so that's why you always want to have a little working capital so you don't run out of money. So a little capital, working capital here, initial rent lease, salaries for the first 3 months. So it includes some initial sources that you need funding for. And this may not be totally accurate. Initial marketing expenditures may only be $1,000. So you can just change it here. And you don't really need all this. Initial rent lease may only be, let's say it's $3,000 a month. So it may not be this month. And staff salaries, you may only need $10,000. So you can change it here. And basically what it's doing is it's going to calculate how much funding you need for you in this section here. And we'll come back to this a little bit later, where that shows up in your financial model. So next thing we're going to talk about is revenues. And so here is where you would add a product or service. So in this case, we're going to say, cups of coffee sold here. And this here says how many units you expect to sell each month. So my math is going to be, hey, I think we're going to sell 200 cups of coffee a day. On average, there's 30 days a month. That's 6,000 cups of coffee in a month. What is our expected annual? And I'm going to point this out. You got to read these things. This is annual sales growth rate. And most companies grow at like 5% per year. So 5% is a good number here. What on average will you charge per product sold? I'm going to start with $3. I'm going to say we're going to sell a cup of coffee for $3. And how much do you expect to raise prices each year? Usually about, 1% is a nice rate to raise price each year. How much does it cost you to produce each cup of coffee sold? I'm going to say it's going to cost us $1 for each cup of coffee sold. It's going to cost $1. And this is the direct expense. A lot of times we get questions like, where do our direct expenses go? They go right here. So the product you're selling for $3 and it costs you $1 each time that you manufacture or create the product. And then finally, how much do you expect direct product costs to grow each year? Let's also say 1% growth of cost there. And that's how we add our products. And we could save it next year, or we can look at subscriptions. What we do is subscription too. So subscription, what I really want to point out for subscription is that, let's say we have a coffee month of the club, and let's say we charge $25 per month. This is a monthly price. How many members do you expect to gain, or you already have, or do you gain the first month? Let's say we're going to gain 20 members a month. This is what I really want to point out. What is projected monthly growth rate? This is a monthly growth rate. We use for subscriptions a monthly growth rate. In products, we use an annual growth rate. So this is a monthly growth rate. Now, very importantly, even a 1% monthly growth rate is more than 12% per year because there's compound growth. So every time you grow 1%, the next month you're growing 1% off that bigger amount. So 1% is actually a very large growth rate for a subscription. I just don't want you to put 10%. You'll see the numbers grow astronomically. Churn rate's also important. What is the percentage of people you're going to lose? Let's say we're going to lose 20%, 0.2%, 0.2% churn rate is, so we're growing by 1% per month. We're churning 0.2% a month. You're going to see how that grows over time. And then direct costs, let's say we're selling a monthly coffee subscription at $25 a month. Let's say it's going to cost us $10 a month. And that's going to give us our revenue. I'll show you in a minute where you can see the results of those revenue assumptions. Now we're going to go through all of our cost assumptions. On the right side, you can see the expected annual growth rate. It's 3% for everything. That's a pretty typical growth rate for expenses and salaries, except for salaries, you're going to grow a lot. This may be a bigger one, but a lot of expenses, 3% is a good growth rate. So here, your monthly salary, let's say you're going to earn $3,500 a month. Let's say the rest of your team is $3,000 a month. Let's say your initial marketing expense is $1,000. Now, very importantly, earlier, you may recall when we did funding requirements use of funds, we included money for initial marketing expense. That there was simply earmarking the fact that we need to raise money for these issues. That did not, when we put it in the other section, it did not go to our financial projections. All it did was tell us that we need to raise money for initial marketing expense and other things. Initial rent and utilities, let's say we're paying $2,500 a month for rent. Insurance, maybe $500 a month. Let's say office supplies, maybe $100 a month. Maintenance, $100 a month. Software, $100 a month. Legal, it's called $100 a month. Let's say we don't have any vehicles, so zero, and other expenses. When any other expenses that don't fit into any of these categories nicely, let's say we have $650 of other expenses. And finally, we're going to enter what we call other assumptions. Is there any other assumptions that we haven't mentioned yet? Here, first off, it's going to how much money do you need? Now, this was copied over from the funding requirements use of funds. It says we needed $180,000 in capital expenditures, and we needed $64,300 in non-capital expenditures like working capital, et cetera. Here, the question here is how much are we going to fund it versus debt versus equity. Debt is essentially taking out a loan. And so in this case, we're going to say 100% is debt. If it was it could be 50-50, it could be whatever percentage you want. It could be 100%, it could be 0% debt and 100% equity. So you put that in here. Corporate tax rate, that has to do with usually 25% is usually a good figure. It's going to be always different based on what state you're in, but 25% generally state and federal taxes is a good rate. Current liability turnover. You can use the tooltips here. We recommend 30 days. This is how quickly you need to pay liability. So usually if you get a bill, you bought a bunch of coffee beans, you get the bill in the mail for $1,000. Usually the terms of most bills are net 30 days. So that's why you got to pay a bill in 30 days. And assets, we recommend 30 in most cases. For most companies, get paid in 30 days. But if you run a coffee shop, this is asset turnover, how quickly you get paid. Most cases, you're going to get paid in 3 days. If most of your clients are paying via credit card is going to pay you within 3 days. So 3 days is good here. Now, if you're selling let's say you're manufacturing a product and selling it to a company like Home Depot. A lot of times a company like Home Depot won't pay you for 180 days. And so you'd have to put 180 days for here. And that's going to be important because a lot of times companies run out of money. You could have a positive income statement. You could have profits, but if you're not getting the money right away, you're going to run out of money. And that's why this is really important. That's why we check for that here. And that's why you want to put here how long it takes you to get paid. Depreciation rate typically is 20%. We say it right here. Amortization rate, 99.9% of you don't have to worry about this. Amortization is the depreciation or reduction in value of a non-physical asset, like the value of a company logo, et cetera. So that's not usually applicable. Debt payback, usually let's say you take a 5-year loan out and the interest rate. So this you're going to get from your bank. Let's say an 8.5% interest rate is sort of typical. And if you have an existing business, you'll have information like cash on your balance sheet. And these are all existing information from your existing financials. But for most of you, if you're starting a new business, these stay at zero. So now we click Save and Next. And this next page here, your summary financials, is really important because it automatically calculates your income statement. In this case, it says we're losing money. We're losing money the first year. We're getting better as we're growing our sales, but we're still losing money in year 5. And so that's not a business you want to run. So the reason why I showed you this is because you want to make sure you can possibly lose money the first year or even the first couple of years, but eventually within 5 years, you want to turn a profit. So in this case here, the reason for this, as you may recall, is I only used $3 for a cup of coffee. I said, we're going to sell coffee for $3. We're going to charge $3 and it costs us $1. So in this case here, I did this on purpose, paying $3. So you could see that the feasibility, this venture is not feasible for selling coffee at $3 a cup. You need a higher price. So if we look at $5 a cup, and I'm going to save this, and recall we were losing money at $3 a cup. Now at $5 a cup, I'm going to go back to our summary financials, and you're going to see that now we're turning a profit. So now we're making $78,000 in the first year and $126,000 by fifth year as a profit. And also as the owner, you also put, I think we put like $3,000 or $3,500 a month in your salary. So really as the owner, you would get your salary plus the net income here. And this is after taxes here. So I wanted you to see that. Now, the last thing I wanted you to see is that if you go to generate your plan and look at the PDF copy or whatever copy of your business plan you look at, you'll have the full financial projections at the very end of your business plan. You'll see the full financial projections. Different charts will be in the body. So like your quick summary financials goes here. And at the very end, you'll see your three main statements, your full 5-year income statement, 5-year balance sheet, and 5-year cash flow statement. And with cash flow statement, this final number here is the cash at the end of the period. You just want to make sure that this is a positive number. And this would only be a negative number in that case that I gave you with like selling to Home Depot and you don't get paid for 180 days. In such a case, even though you'll see that you're profitable, you're making money, but you could run out of cash because you're not getting paid fast enough. So you always just want to make sure that this number here, the bottom line here, are always positive. Once again, 99% of cases it will be. That's a nice check for you to make sure that you never run out of money, that you have enough money on hand. So in this case here, you're not running out of money. You have enough money on hand to run your business, because once again, usually the first few months of a business, your business is spending more money than you're bringing in. So I hope that answers any questions you might have about your financial model. And any other questions, feel free to shoot us an email, and we're happy to help you.